Right, so this is your next 1.3.2 revenues, costs, and profits, and it covers break even as well. So basically, this is chapter 14 and 15 of your book. Right, so this is your chapter 14 revenue, cost, and profit. So, revenue is basically money, value of money business makes from selling its product. The formula is price times quantity. You have to memorize the formula, it's not given in the exams. Costs, basically two type of cost: variable cost, fixed cost. Fixed cost do not change with the output, whereas variable costs are directly related to output. For example, raw materials, if you produce more units, you use more raw materials. Example of fixed cost: rent and salaries. Do memorize these examples because they come as 2 marker, 1 marker, etc. So for a fixed cost, the graph looks like a straight line. For a variable cost, the graph will look like this. Total costs, you basically add these two costs: total fixed costs plus variable costs. For example, if that's the table, variable costs 15, normally variable costs are given per unit. Salaries 1000, rent 400, number of units sold 100, price is 2. So for revenue, you just multiply price times quantity, 2 times 100, so 200. Total cost, you calculate fixed cost, so these are fixed costs 1400, and that's variable cost per unit, 15 times 100, 1500, and that's your 2900. So that's your revenue, costs, and profit is total revenue minus total cost. Whatever is left after paying the cost is the profit. Next is interest paid on your loans. It's basically your total repayment minus borrowed amount divided by borrowed amount times 100. So if you do this example, a business borrowed £50,000 from a bank. The business repaid 60,000 in total. Calculate the percentage of interest. So you do 60,000 total repayment minus borrowed amount 50,000 divided by 50,000 times 100. You get 20%. Break even is basically a point where your total costs are covered, and so total cost is equal to total revenue. So at this point there is no profit or loss. The formula of break even, memorize this: fixed cost divided by selling price minus variable cost. So if you want to remember which one comes, so alphabetically F, S, and V. So that's the graph. Memorize this because sometimes you get questions on this. So this is the fixed cost. The line which starts after fixed cost is total cost. The line which starts from 0 is total revenue. Where it coincides, meets, that's break even point, that's break even output, that's break even revenue and cost. So you should be able to read the graph. Margin of safety is basically actual or budgeted sales output minus break even sales output. So for if that's the break even output and in actual they're producing this much, that's your margin of safety. So your current output minus break even output. Impact of changes in revenue and costs. So if revenues increase, it makes the revenue line steeper, so break even happens earlier. Whereas cost, increase in cost, it delays the break even, makes it shift towards the right.